welcome everybody to the Multifamily and More virtual mastermind, where we talk about real estate, mindset, or anywhere in between. I'm your host, Jamie Gruber, with my co-host, giving more, as the shirt says, Benoit Malige. How's it going, Ben?
I'm doing pretty well, Jamie.
I'll bet you are. It became 60 degrees here the day Labor Day hit, but by you, it's still 94, I'm sure.
It's pretty hot. Yeah, still uncomfortable.
I'll bet, but glad to have you here tonight. I'm excited. Tonight is going to be extremely interactive, very, very informative. I can't wait for people to kind of get a taste of what our special guest has to offer here. Tonight, though, I want to start with a quick sponsorship, a quick plug. I'm a big fan of the concept of community. Multifamily More is a component of that. I had the privilege of being part of an organization called GoBundance, which is a mastermind for men and now women that have a certain net worth. So I've been fortunate enough, again, to be part of that. As I've joined that and I've gotten a ton of value from it, and I hear a lot of people that are very interested in what GoBundance is and what it has to offer. People like Brandon Turner and Josh Dorkin and David Green are all members, friends of Jay's in the Bigger Pockets community, along with others. I've gotten closer and closer to the organization and actually have partnered with them recently to build a mastermind that allows people to develop one day to get to that GoBundance level, to develop millionaires, essentially. So I'm very, very proud of that. We're doing a soft launch of a program called Emerge in November for those looking to get themselves into an organization like GoBundance, get into a mastermind, get proximity to some of the guys and gals that I get to get proximity to. Go to GoBundanceEmerge.com. We're selling the program for $397 right now. It's 50% off. Type the code EMERGE in the coupon section, and you can join up our first run of GoBundance Emerge, which launches in November. So hopefully you join. Would love to see you there. Great program. More details on the website. Check it out. But I wanted to make sure I plugged that tonight and offered that up to all of you fine people out there. So with that said, let's get to our esteemed guest. Mr. Jay Scott is the host of the Bigger Pockets Business Podcast. He's an author, he's an investor, and an overall Renaissance man. He's also a return guest. Ironically, I think about the same day last year, because I distinctly remember saying last time we were on, man, I wasn't sure I was going to do this because it was 9/11, 2 days from now. So we have him back a year later to talk about all things economy, and oh my God, how much has changed from then to now. So welcome, Jay. Glad to have you.
Thanks. Thrilled to be here. Thrilled to be back. Thanks for having me, guys.
Of course, I caught you mid-cough.
Right in the middle of the cough.
Any other time you would have been good. So no, glad to have you.
All right. So yeah, Jamie, like you said, a lot has changed since you were last with us last year. So we're going to try and focus on a few things tonight, like where do you see things going in the next 12 to 24 months? What should people be considering in terms of, real estate perspective? If time allows, I'd love to also touch on some non-real estate related topics, like other hedges of investments, maybe gold, cryptocurrency, the stock market, but also small businesses. I remember a post that you made on Facebook a few months back, which really hit home personally. I think it was something comparing the 2008 golden years for real estate with 2021-22 for small businesses. So if we have time, I'd love to talk about that. But let's start from where we are now. I remember you telling us that some real estate strategies can work in any market. You actually wrote a book on that, which is called Recession-Proof Real Estate Investing. Maybe we can start with the Fed's stance on inflation. What is it, and what do you think it means for real estate in the next 12 to 24 months?
Yeah, so this has been a big topic of conversation amongst a lot of my colleagues and myself over the last week, because the Fed did come out last week and they kind of, for the first time in a while, kind of updated what their view of inflation in the U.S. should be over the next few years. And let me start with everything we discussed tonight. I know the questions I always get are, where's the market headed, and what should I be investing in, and where's the economy going? And so I kind of want to start with, those are all valid questions, but nobody has a crystal ball, and I'm the first to admit that I'm guessing as much as anybody else. And so what I encourage everybody to do is don't necessarily ask the question, where's the market heading? Where's real estate going? Where's the stock market going? Where's the economy going? Instead, spend your time actually getting educated on how the economy works and what the underlying concepts behind economic movements are, economic concepts behind the things that actually drive these markets, so that you can make your own informed decisions, and you can follow what's going on, and you can come up with your own ideas on how it's going to impact the markets. Because if you ask 10 different economists, you're going to get 10 different answers on where things are headed. And those answers are going to change every single day. So I'm happy to give my opinions there, but just keep in mind, I'd rather talk more about how things affect the economy and how things work, so that everybody else out there can kind of understand what's going on. And so that kind of leads me into the answer to your question about inflation. And so let's start with what inflation is. Most people know it's basically inflation is, and there's a more technical definition, but the definition that a lot of people like to throw around is it's the increase in the price of goods and services. So when we see inflation, we see things getting more expensive. We see our products getting more expensive. We see services getting more expensive. We see real estate getting more expensive. We see things like rent getting more expensive. That's the common definition of inflation. Now, is inflation good or is inflation bad? That's another big question that people get. And it really depends on your perspective. So if you've been paying attention the last decade or so, the Federal Reserve, the people that set a lot of the interest rate targets for the US, they've decided that they want for us to have about 2% inflation. Every year, the price of goods and services increases about 2%. Now, why is that? Why isn't it 0%? Why isn't it 5%? Why isn't it negative 3%? So generally speaking, prices going down, so the opposite of inflation, either disinflation or deflation, depending on what you want to call it, that sounds like a good thing. Things get cheaper, we can buy more. But in reality, disinflation or deflation is actually bad for the economy, because when things cost less, businesses are like making less money. Now, the goal of businesses isn't always in line with the goal of consumers. Consumers want to pay less, businesses want to charge more. From the Fed standpoint, it's more important that businesses get what they want and what they need to keep the economy going than for consumers to get what they want and what they need. So the Fed tries to target a little bit of inflation, which means prices go up, costs go up every year just a little bit to keep business profits increasing year over year. So typically speaking, we want to get a couple percentage points of inflation. We want to see about 2% of inflation. The other thing is if we start to see deflation, if we start to see prices going down for whatever reasons, and we can talk about that later if you want, if we start to see that, deflation can tend to spiral out of control a lot more quickly than inflation. So if we ever let inflation stop and we start to see a drop in prices, that can spiral out of control and we can see a really bad result. So pushing for a little bit of inflation every year is a good thing. Historically, that target's been about 2%. And for the last 10 years, the Fed has said, we want 2% inflation. We want to see the price of goods and services going up an average of about 2% per year. Last week, Jerome Powell, the head of the Federal Reserve, came out and for the first time in a while kind of changed that outlook. From a semantic standpoint, it didn't sound like he changed it much, but it actually was. What he said was, we want to see an average 2% target over the long term for inflation. So instead of saying we want inflation at 2%, he said we want the average inflation at 2%. Given that we've seen less than 2% inflation for a good part of the last few years, that means he actually wants to see greater than 2% inflation moving forward so that we see a long-term average of about 2%. So that means next year and the year after and the year after, the Fed might actually be targeting 2.5% inflation or 3% or even 3.5% inflation. Now, how do they do that? They have a lot of different ways of doing that. The biggest one is interest rates. By manipulating interest rates, you can impact inflation. When we drop interest rates, well, what happens when you drop interest rates? Two things. One, people don't like to save money because you're not making any money putting your money in the bank. So when you don't save money, you're spending it. Spending money, that helps the economy. The second thing when you drop interest rates is that it gets really cheap to borrow money. And when it's cheap to borrow money, everybody borrows money and they buy lots of stuff. Again, that helps the economy. So by dropping interest rates, we discourage saving, we encourage spending, and we really rev up the economy. If we want to slow down the economy, if we want to slow down inflation, what we can do is we can raise interest rates. And that'll encourage people to save, that'll discourage people to borrow because borrowing becomes more expensive, and you slow down the economy. And so typically speaking, when we see interest rates dropping, that's a way to spur the economy, increase inflation. When we see interest rates going up, that's a way to slow down inflation and slow down the economy. So what does all this mean? If the Fed is saying we want more inflation over the next few years, the best thing for them to do is to lower interest rates. Well, interest rates are already pretty much at zero. So the first thing to realize is by the Fed saying they want to increase interest rates, or increase inflation, that means it's very unlikely that over the next 3-5 years, we're going to see an increase in interest rates. So reading between the lines, the Fed saying they want higher inflation, the first thing that tells us is we're likely to see low interest rates for the next 3, 5, 7 years. Okay, so that's the first piece. Now, the question becomes, is low interest rates good? Is inflation good? As real estate investors, inflation actually is pretty good for us. We don't want too much inflation, but a decent amount of inflation is actually really good. And why is that? Again, 2 reasons. One, when prices are inflating, what else is inflating? Rents. When everything's going up, 2 big things go up. One, wages go up, and rents go up. So as real estate investors, we buy a $100,000 or $200,000 property. Next year, or 2 years from now, or 5 years from now, we've still paid $100,000 or $200,000 for that property, but wages are higher and rents are higher. So we're now making more income from that property that we paid the same amount for a year or 2 or 5 ago. That's number one. The second piece is if we borrow money, if we get debt against property, inflation, the best hedge in the world against inflation is debt. And the reason is, let's say you have a job, you make $100,000 a year. And let's say your mortgage payment on your rental property is $1,000 a month. You're putting essentially 1% of your paycheck, 1% of your annual income towards your debt every month. Now, let's say we have inflation and let's say prices double, everything doubles, including your salary. When prices go up, salaries go up as well. So now you're making $200,000. How much are you paying on your mortgage every month? You're still paying $1,000 a month. So now you're paying off the same mortgage, but with half as much of your income. If your income goes up even more, you're paying off even more of your mortgage with the same amount of income, or you're paying off the same amount of mortgage with less of your income. Yeah. Basically, inflation allows you to pay off your mortgage with what we call cheaper dollars. So if you're a real estate investor, inflation is good because your rents are going up even though the price of your properties didn't go up. You've already bought them. And 2, any debt that you have before the inflation starts, you're paying off with cheaper dollars. So inflation is a good thing. The Federal Reserve is targeting inflation, higher inflation over the next couple of years. So long term, and I know I'm long-winded about this. But
no, this is great.
It's important to understand the mechanisms and not just, I could say, yeah, inflation is good.
Buy or don't, right? Yeah.
Why. Yeah. So over the next couple of years, I think that the Fed's target of higher inflation is going to be a good thing for real estate investors, and it's especially going to be a good thing for real estate investors who have debt against their properties.
Okay. That's very interesting because I think it's a great explanation. And again, I kind of made a point here in the notes, guys. If you have questions, just start putting them in. We'll pull them out as we go along, even if it's not related to exactly what we're talking about right now. So inflation is good. So that means that you have
a little bit of inflation is good. Too much inflation is bad.
Right. That means, and
a little bit is good.
I love that you said how debt is the best hedge. That's interesting because we'll talk about hedges a little bit later, things like gold and crypto, and get your opinion on that if we have time. But if inflation is good, that to me sounds like as an investor, you're geared up. You're ready. This is high times. The economy is going to be really, really strong over the next 2-3 years from your perspective. You're seeing no recession, only good times over the next 2-3 years. True?
No, not necessarily. Well, not necessarily. Again, I don't have a crystal ball.
No, right, yeah.
So one of the things I've done in my life is I've been a professional poker player. And one of the things I've learned by playing poker is that you can know where things are going to be over the long run. If I play 10,000 hands of poker, 100,000 hands of poker, I know that I'm a winning player. I've tracked enough hours and enough hands that I know I'm a winning player. But the next hand that I'm dealt, I could get a bad beat.
Mm-hmm.
The next 50 hands I'm dealt, I could get no good cards. Anything can happen in the short run. Long run, we typically know what's going to happen. It's the same way with the economy. Long run with the economy, typically we're going to see an increase in prices, an increase in asset values, an increase in everything. So the economy gets better over the long run. But short term, we don't know what's going to happen. Now, we certainly have an idea of what's happened the last few months, and we can talk about this. So let's talk about where we're likely to be in the next 6, 12, 18 months. Now, again, I'm going to throw out the disclaimer that I don't have a crystal ball. Everybody's guessing, but I can give you some of the fundamental things that are going on, and we can use our logic and common sense to kind of discern what might happen. So let's go back 6 months. We all know what happened about 6 months ago. COVID hit. Basically everything stopped. The economy stopped. We had 28, 30 million people out of work. Businesses stopped. GDP dropped to negative 32%. Things were pretty bad. And we all expected that the world was going to collapse. The United States was going to collapse. And it was just going to be 1930s. Here we are 6 months later. And for the most part, that didn't happen. Certainly, there are a lot of people struggling out there. I'm not going to argue with that. I'm not going to deny that or pretend that's not the case.
Sure.
But for the most part, things aren't where we expected them to be when the economy shut down. So why is that? Essentially, two things happened back between March and June. One, the government took care of mid and large size businesses. They did that through a number of stimulus programs, PPP, EIDL, some other programs direct to businesses. Basically, they injected money into businesses to keep them going, to keep their employees getting paid. So business owners were able to kind of keep afloat. Large business owners actually have done pretty well. And anybody that's followed Jeff Bezos over the last few months knows his net worth has kind of doubled to over $200 billion. So a lot of people have done really well, but all these businesses have, or not all of them, but a lot of these businesses have been able to keep their employees employed. They've been able to keep their business owners and their shareholders getting paid. And then on the other side, there are a lot of businesses that have been struggling, a lot of people that have been laid off. We still have about, 8 million people unemployed. So there's a lot of unemployment, but we've taken care of those people as well. The government's taking care of those people as well. Unemployment benefits have increased. A lot of people are making more money from unemployment benefits than they were making 6 months ago at their job. The government sent out stimulus checks, $1,200 stimulus checks to basically everybody that wasn't making over a certain amount of money. So even people that lost their jobs had money coming in. Now, couple that with the second thing that happened, which is everything shut down. So people didn't have any place to spend their money. They weren't going out to the movies. They weren't going to ball games. They weren't going out to eat. They were staying home, watching TV and cooking their own food. So the savings rate back in March, April, May, June skyrocketed. People were saving more money over the last few months than any time since the early 1980s. So even though the economy is kind of collapsing around us, the impact on most people has been negligible. And as long as the government keeps printing money and doing stimulus and handing money to people, we're probably going to see that continues. We're probably going to see that people are going to keep doing okay and businesses are going to keep doing okay for the most part. Again, plenty of exceptions. But at some point, that has to stop. At some point, the government has to say, we can't print any more money. We can't hand out any more $1,200 checks. We can't keep giving out unemployment benefits of $600 a week. We can't keep giving businesses money. And at some point, the government's going to say, okay, you're on your own. And now what's the other thing? I kind of skipped over this, but the other two things that have been going on is people that haven't been able to pay their mortgages have been given the option to do forbearances. So 8, 9, 10%, depending on which type of loan servicer you're looking at. 7, 8, 9, 10% of people are in mortgage forbearance, meaning they are not paying their mortgage, but they're not getting kicked out. They're not getting foreclosed on. So that's another thing that 7, 8, 9, 10% of the population is saving money by not paying their mortgage. There's been a moratorium on eviction, so people don't necessarily have to pay their rent. There are a lot of people who aren't paying their rent or who are behind on their rent, but they're not getting kicked out of their homes. So there are a lot of people who are being kept afloat by kind of all of these grand measures implemented by the government. And at some point that's going to stop. And when that stops, it's musical chairs. A lot of people are going to be left without a chair. A lot of people are going to have to figure out how they're going to pay all their back mortgage, how they're going to pay their back rent. If they've lost their job, how are they going to live on the lower unemployment benefits? If they're a business owner, what are they going to do if they stop getting stimulus from the government and have to shut down their businesses? Like I've heard numbers, the National Restaurant Association is saying that more than 60% of independent restaurants are likely to go out of business. That's just restaurants. Imagine all the other businesses and all the other industries. So at some point, the music's going to stop, and we're likely going to see something that's worse than what we're seeing today. Now, is it going to be 2008 bad? Is it going to be 1930 bad? Is it going to be worse than 1930? Or maybe it's going to be kind of like it is today, where it's a typical recession. We're seeing 8% unemployment. Maybe we see negative 2 or 3% GDP growth. We don't know. And if anybody tells you that they know what's to come next, they're lying to you. Everybody's guessing because we don't know how quickly the government's going to shut off that spigot of cash. Yep. And we don't know what they're going to do to try and help the people that are suffering after that.
No, that's an amazing outline, and there's a lot there. And I think what we'll do is dive a little deeper. We got some questions coming in that I want to get to, but then also talk about what does one do? Like, how do they, what strategies, that sort of thing. I want to make that actionable for people. You talked a moment ago about at some point the merry-go-round will end, or whatever the case may be, right? I'm just kind of curious, and again, projection or thought or whatever, is that just if the government decides to turn the spigot off? Or maybe a better question, can they? When you start, the whole concept of modern monetary theory, MMT, for those of you maybe not familiar, is essentially like just give money away. I'm probably understating it significantly, but that's the simplest version I can come up with it. Ever since quantitative easing started after 08 or around 08 or whatever, we've been printing. I mean, there might have been a little period of deflation there, but we've been printing and printing and printing. Can we stop? Will we stop? And if we can't or won't, what stops the merry-go-round?
Yep. So you mentioned modern monetary theory. This is a new theory of economics that's not new, but it's kind of gaining popularity because it makes us feel better about the narrative today. Right. Basically, one of the central themes is as long as interest rates are really low, you're not paying a lot of interest on your debt. And in theory, you can have a ridiculous amount of federal debt and not have any major economic problems. Yeah. Right now, our debt is about equal to a year's worth of GDP, meaning we are in debt about the same amount of output that's produced by the country in a single year. It's actually a little bit more than a year as of the last month or two. Modern monetary theory says if interest rates are low enough, you could have 5, 6, 7, 8, 9, 10 times your annual GDP in debt and still not be at risk of defaulting. Mm-hmm. Now, that says a couple things. Let's say that's true, and let's say we want to test that out. That says that most likely for the rest of the lifespan of U.S. currency, the U.S. dollar, we're going to have low interest rates. Mm-hmm. Because it's not like at some point we're going to have $30 trillion worth of debt and we're going to have a president that comes along and says, okay, we really need to pay this off over the next 60 years. That's the problem with a 4-year president. I mean, obviously it's good that we have term limits, but a lot of times presidents and Congress don't think long-term because they're just trying to make themselves look good and everything.
They have to pander, right?
4 years.
For sure.
So the likelihood that this debt's ever going to be paid off or even go down is relatively slim. So from my perspective, I expect that we're going to have low interest rates for as long as the U.S. dollar is the U.S. dollar. Okay. Now, that seems like a crazy thing to say, but there are some really smart people. I don't know if you know Kathy Fettke. I'm guessing a lot of your listeners probably may have heard of Kathy Fettke. She's She's a real estate investor. She runs an organization called Real Wealth Network. She's she's been on Fox News and CNN talking about the economy. And she and I have been talking a lot recently, and we've been on a lot of the same podcasts. And she's of the firm belief that in the next couple of years, we're going to see a major economic reset where basically they figure out a way to dismantle or reduce the debt in some brute force way. We don't know exactly what that looks like. And I know people look around and say, no, that can't happen. That's ridiculous. But if you look back through history, it was only about 80 years ago that the last time we had a major currency reset. Back in 1944, there was a major worldwide currency reset where the US dollar essentially emerged after World War II as the main currency of the world. And so we've had a reserve currency for 80 years. If you look back historically, read Ray Dalio. I'll recommend everybody here read Ray Dalio. You look back through history, typically reserve currencies, and a reserve currency is just the currency that kind of dominates the world economic markets. They tend to last about 100 years. We're about 80 years into the dollar being the world's reserve currency. So if history repeats itself, and I'm a big believer that it does, we're probably within 20 or 30 or 40 years of there being some type of economic reset. And a lot of people think it's probably a lot closer than that. So long story short, modern monetary theory, we could see a lot of debt for a long time. It's very possible that the government's not going to turn off that spigot, but there is a lot of pressure to kind of not run up the debt. So one party has kind of run on this notion of we need to control the debt. The other party has run on this notion of we need to spend the money, but we need to spend the money on certain things. I don't think either of the two major political parties in this country have kind of settled on we can just spend money left and right and give people free money for a long time without repercussion. So I think that after the election, if I had to make a guess, and it doesn't matter who wins the election, I think once the election's here, we're going to see somewhat of a slowing down of the stimulus. We just hit $3 trillion for this year. That is probably unsustainable. So even if we just cut the stimulus in half, we're still printing a lot of money, and we're probably going to have a big impact on the economy. So I think winter of this year, spring of next year, that's when we're going to see what is going to happen with the economy, whether it's going to get much worse, whether it's not going to get much worse, whether it's going to start to get better, whatever it is. I have a feeling we're going to see it in the next 6 to 8 months.
Got it. You just covered actually a few different questions too. We had one from Craig in the Q&A about the world reserve currency. Is there a chance of it going away? We had a couple questions about the election on the live feed from Jim Farmer, and somebody else I thought had a question in there. Daryl had a question: with inflation, should we expect a drop in rents? If so, what range? And you've covered that you see, well, not you see, but with inflation, rents will increase. As a result.
One thing that's worth mentioning, and I cover this in the recession-proof real estate investing book, is that historically, even during, and to kind of back up a little bit, every recession is caused by something different. Every recession is driven by something different and affects different parts of the economy differently. So 2008 was a real estate recession. There were fundamental issues with foundational concepts in real estate and lending markets in the US. And that led to the 2008 recession. 2001 was driven by 9/11 and the tech bubble. If you go back to the early 90s, there was a savings and loan crisis. You go back to the 70s, it was oil. You go back to the Great Depression, it was tariffs and debt and a whole bunch of other things. Every recession is kind of a little bit different. Not every recession impacts real estate the same way. So 2008 obviously crushed real estate. You go back to 2001, which was a decent sized recession, real estate barely got hit. In fact, in a lot of markets, real estate didn't get hit at all. Go back to the early 90s, real estate got hit pretty hard. Go back to the 70s, real estate didn't get hit. So whether or not, just because we're entering into a recession, just because the economy might turn down and get bad, doesn't necessarily mean that real estate is going to get hit. Good chance it will if there are issues in the real estate market, if prices are overinflated, if there are lending issues, but it's not a foregone conclusion. All that said, during a lot of recessions, rents don't get hit much at all. So even if you go back to 2008, in most markets, rents didn't drop more than 8, 9, 10%. In a lot of markets, rents didn't drop at all. And in a lot of markets, especially in the B and C class properties, rents increased during 2008. So one of the things I talk about is that buy and hold real estate tends to be pretty recession resistant. The nice thing is, once you own the property, if I buy a $100,000 property and next week it's worth $1,000, I don't care if it's still generating the same cash flow that I projected when I bought it. I was buying it for the cash flow. I wasn't buying it for necessarily the asset value. And in 5 or 10 or 15 years, the asset value is likely to come back. Mm-hmm. So rents tend not to drop very much during a recession. I don't want to say never. I don't want to say it's not going to happen. Anything could happen. But historically speaking, rental real estate is a pretty good recession-proof investment.
Yeah, I completely agree. In fact, you're making me harken back. We were talking before we started, I moved to Boston in 2008, and I remember renting, or maybe it was 07, whatever, but it went up. The next year it went up fairly significantly. And that was an A-class, I'd call it an A-class asset that I was living in. And yeah, I don't remember that. And it's funny, I talked at the beginning about being part of masterminds, and I was at a retreat recently with a bunch of these guys talking about what is the opportunity after this recession. Everyone is less concerned about real estate being, yes, I mean, there'll be opportunity in real estate. There always is. You can find it in different markets and, whatever. But the big market that's being talked about right now is small business acquisition. Just the multiples have decreased significantly from pre-COVID to post-COVID on buying, say, an HVAC company. So opportunities may be there to integrate. So if you own 40, 50 rental properties or 200 units or whatever in a certain area, do you buy an HVAC company and install that into your integration so that you've got a low-cost company that you can use for yourself as well as third-party out? That seems to be potentially, to your point, this recession's correction and buying opportunity more than maybe real estate. Fair?
Yeah, absolutely. Like 2008 was real estate got crushed. And so that was where the opportunity was to buy low and hold on for a couple of years and make a lot of money. This recession, this economic event that we've seen over the last 6 months, it actually hasn't happened yet. Like I was expecting 6 months ago when COVID first hit, I would have said that there are going to be a ton of great business opportunities over the next 6 months. All these businesses going out of business and being able to pick businesses really, really cheap. And what we found is because there's been so much money pumped into the economy and so much money given directly to business owners, we haven't seen that. PPP actually kind of did a weird thing. There are a lot of businesses, and I have one of these businesses that likely would have shut down during COVID. That business was unsustainable, but the business owner took PPP money, took basically free money from the government, money that can be
and not paid back, essentially, right?
Not paid back, yeah, exactly.
Yeah, I can't think of the phrase either.
Forgiven.
Forgiven, thank you.
Right. A lot of business owners took this money that will be forgiven if the money is spent on payroll and a couple other things. As soon as they took that money, they're basically forced to use that money for payroll. Otherwise, they have to pay it back. Mm-hmm. So even if they want to shut their business down, the smart thing to do is to bring on employees, even if the employees aren't working, and just hand them a paycheck for a few months to use this money so that it'll ultimately be forgiven. And so there are a lot of business owners who are ready to shut their business down, but they took this free money and now they're just paying employees and just waiting for that money to run out. Once that money runs out, they're probably going to shut their businesses down. A lot of them are going to shut their businesses down, but that hasn't happened yet. So I do expect that, again, over the next 6, 8, 12 months, maybe even the next year or two, we're going to start to see a lot of businesses starting to struggle. A lot of business owners, there are a lot of business owners who are nearing retirement, who don't want to rebuild. So they're going to be ready to get out. There are going to be a lot of business owners who just can't handle the stress and want to go back to their 9 to 5. There are going to be a lot of business owners who basically they want some continuity for their employees, and they're going to basically be willing to say, hey, if you take my employees, you keep paying them, you keep the business going, I'm basically going to just hand it over to you. We're already starting to see this. Business owners who are just saying, just take my business, don't fire my employees. If you can promise me that you'll keep my employees employed, I'll just give you the business. And I have a feeling we're going to see a whole lot more of that over the next couple of years. And so this is very much like you said, 2021, 2022 could be what for business what 2008, 9, and 10 was for real estate.
Yeah, no, it's interesting. And one quick follow up on the topic of reserve currency. I actually meant to ask you this, but wasn't sure. What, again, you don't know, but projection. Somebody asked, do you think the euro would be the replacement? Maybe the yen. Maybe it's a completely different currency. Do you have any thought on what potentially could be call it a threat to the U.S. dollar being the reserve currency?
I actually think the biggest threat is for there to be some worldwide consortium that gets together and says, let's create a new currency.
Yeah.
Or for the US to basically say, we are going to reset the dollar, and the dollar taking over from the dollar as the world's reserve currency with a whole lot less debt against it. Now, there is a lot of talk that there are international groups forming. China and Russia are working together to kind of hurt the dollar. So they've been doing a lot of trade back and forth that's not in dollars. There are a lot of other countries, Western Bloc countries, that are no longer doing trade in US dollars. Basically, the thing that makes a reserve currency, it's not like somebody says, okay, let's vote on it. The reserve currency is just that thing that people tend to use. They have the most confidence in it, and because it's the most stable currency. If people stop using the dollar, if other countries decide to stop using the dollar, either because they no longer trust it, because they think the U.S. might default on their debt, that's the biggest risk with debt. If somebody asked in the chat, like, what's to stop the U.S. from printing 6 or 8 or $100 trillion in debt? The biggest thing is if we have runaway debt, countries like China that buy a lot of our debt, that when we issue it, they're going to say, this is unsustainable. I don't believe they're really going to keep paying us, and they're going to stop buying our debt. And the minute they stop buying our debt, well, that printing that money doesn't really help. We need somebody to buy that debt, especially when it comes to international exchange. And so the biggest risk to printing too much money is that we lose the ability to keep printing money and to keep selling bonds to countries like China. And if these countries start losing faith in the US dollar and they start trading in some other currency, whatever currency that is going to gain hold, is going to get stronger, the dollar is going to get weaker, and there could be a tipping point at some point where the dollar just kind of slowly fades away as the reserve currency.
Crazy. It's interesting. It's very interesting. And it's, more than one smart person is speaking about this. So it's good for people to kind of, perk up and pay attention to this incredible content. Thank you, Jay. I mean, you're on freaking fire 40 minutes in.
And it is interesting that I know it's so easy to get stuck in this mindset that the U.S. is such a dominant economy, and we have such a dominant military and such a dominant currency, and nothing could ever stop that. Like it seems inconceivable that the dollar could go away as the reserve currency. And I get that. I feel that too. Like there's a part of me that's just like, how could that ever happen? Right. But then you look back through history, and every 100 years or so it happens. And there have been some much stronger economies, some much stronger countries, some much stronger militaries, some much stronger currencies that they've all gone away. So at some point it's going to happen. And it seems crazy to think it could happen anytime soon. But these are the sorts of things that just kind of happen, and we don't even realize it's happening. And before you know it, it's gone.
Well, who would have thought, I mean, at a smaller scale, but who would have thought, of the impact of a COVID, right? Like, I mean, I don't know why this is jumping to mind, but the NFL, I'm a football fan. It's coming up. Juggernaut, right? Cap is going up. Salary cap's going up every year. It's what's going to stop the NFL? Well, who saw this one? And you could use that for many smaller examples than the potential of the U.S. dollar not being the reserve currency. But there's a lot of business. There's a lot, like not going to a movie theater. My gym just opened today for the first time in 6 months in Michigan. So, who would have seen any of that? I think that is a small scale, I don't call it a warning or validation of your point that it looks unstoppable until it's not.
Yep. And sometimes all it takes, there are plenty of countries out there that are trying to gain a stronghold that want to emerge victorious in this economic battle, this worldwide economic battle. And something like COVID, I mean, the risk is always to the incumbent. The risk is always to the strongest force when something like this happens. So everybody's looking at China's economy and saying, hey, China's getting hit pretty hard by COVID. And it's true. Their economy is taking a big beating. But at the end of the day, the U.S., because we're the most dominant player, we're the ones that have the most to lose. We're the most at risk. And so even though everybody else is getting beaten up pretty bad right now, we're in the riskiest position.
All right. We're gonna pivot here in a second to strategies. And there was a great question here from Daniel about multifamily and single family, like your viewpoint on buying in both of those asset classes right now. Before we do, because I could just keep going. Ben, I don't want to step on you here, buddy. You're the silent assassin over there. What do you have? Any questions? Anything that's jumping up that you want to talk about, or you just comfortable with the role, my brother?
No, I'm comfortable with what's going on right now. I did like the small business discussion, and I was curious, to know what Jay was kind of looking at and maybe holding for. We can talk about that a little later, but go ahead.
Okay. Well, I before I go to that, the idea of single family, multifamily, and maybe this is just a quick snippet here, but in this discussion about hedges and everything like that, and what the dollar will do, and is it backed, is it not? Do you hedge anywhere? Gold, crypto? Like where what do you recommend, or what do you advise people in precious metals or crypto, if anything at all? Are you saying cash is king, leave your gold and crypto somewhere else, stockpile cash right now?
Okay, so first, I don't recommend anything. Because
my bad.
I'm wrong a lot. Like people don't realize how, like, for some reason people think I'm wrong a lot. It's hard not to be wrong. I make a lot of guesses, so it's hard not to be wrong a lot. So please don't do anything because I'm saying it here. But I'm always happy to talk about what I'm doing.
Sure.
So yes, I own a decent amount of physical gold. When I bought it a couple years ago when it was really low. Basically not thinking of it as like stockpiling because there could be some catastrophic event. It was basically, I know the economy is cyclical, and at some point we're going to see a 2008 recession again, or some type of recession again. So a couple of years ago, I thought, gold's really low, cheap. Silver's really cheap. I'm going to buy it. And at some point it's going to be worth a lot more. And it's a good hedge. Like I didn't buy it thinking it was going to outperform my real estate returns, but I figured that it would at least be profitable long term, and it's a good hedge. So if something really bad happens, like COVID, which hasn't resulted in gold skyrocketing, but it could at some point, I'm glad I have it. So yes, so I do buy some precious metals. I like to diversify into a number of asset classes. But I don't buy a lot of things that I have no control over. I'm not a stock market guy. I've owned very little in the equities markets. So just because I don't feel like I have any control or insight, it's way too efficient of a market. Basically, the value of any particular stock at any given time is a perfect resemblance to the value of that stock at any particular time, what somebody's willing to pay. Real estate, the nice thing is I can get real estate. I'm buying lots of real estate these days that I can turn around and sell for more. Because real estate's an inefficient market, or relatively inefficient market. The price that you pay isn't always reflective of exactly what the value is. So I like a lot of hedges. I'm doing some crypto hedging. I like businesses. So I've invested in a number of businesses over the past couple months. We started a mold remediation business. We're in the process of buying a plumbing business. We're looking at a couple other service related businesses that are related to real estate, because I know real estate and because there's synergies there, because I have a built-in customer base. There are a lot of investors I know that can use these services. So even if I can't grow the business or can't organically with retail customers, I can at least keep it going with investor customers that I know and are in my network. So that's kind of where I've been on the business side of things. And I've been buying a lot of real estate. To your question about, do I keep a lot of money in cash? I was keeping a lot of cash up until about 2 or 3 months ago. I like cash, but I'm also very concerned given a couple things. One, the Fed targeting inflation. Inflation is really bad for dollars. The more things are worth, or the more things cost, the less a dollar is worth. So higher inflation is bad for cash. The dollar was super strong for a couple months. When the dollar is super strong, it pretty much only has one way to go. It's going to get weaker. So I have a feeling we're going to see a weaker dollar over the next couple months. I don't want to get political, but there was a trade war going on 6, 12, 18 months ago that we don't talk about anymore.
Right.
But if you look at the data, we have a higher trade imbalance last month than we've had at any point since the mid 2000s. So we're running the risk of, if this trade war reemerges because we're seeing a higher trade imbalance, that can hurt the dollar. So I'm not a huge fan of holding a ton of cash right now. That said, I think everybody should have some cash just as to mitigate risk. And the nice thing about cash is if good deals come along, it's nice to have it.
Yeah.
But I have been buying a lot more real estate than I've been buying in a long time. I stopped buying about 1.5 years ago. I started selling a lot of stuff and I started sitting on a lot of cash. Over the last month and a half, we've bought something like 15 rentals, half dozen flips, and we're closing on a 150 unit apartment complex next week.
Congrats. That's amazing.
Thanks. So,
That's incredible.
So
No, this
we're buying a lot
is
of real estate.
absolutely, and that's the thing. I think this question, and I've gotten it from a few different people prior to this, is around like, what do I do with my money, right? What do I do with my money? And I think what you're talking about, whether it's gold as a hedge, real estate as a hedge and an investment, obviously, is putting your cash in hard assets. And when you say have cash left over, this doesn't mean that you're sitting on, $4.62 in your bank account. You've got your reserve in case something happens. You can pay for your life, as well as some money to kind of deploy as you need to in deals that pop up, opportunities that pop up. On the gold front, I heard this recently, and I thought it was a fascinating way of putting it in perspective. I think the Fed was created in 1913. Does that sound right, Jay?
It's been in stages, but yeah, originally 1913.
1913. In 1913, a bar of gold, an ounce of gold, was about $20. And with that $20, with that ounce of gold, you could buy a tailored suit, right? Today, an ounce of gold is about $2,000. And with that same ounce of gold, you can buy a tailored suit, right? So whereas the dollar, I want to say, is 95% less valuable than it was when the Federal Reserve came into play. So there's a question here about how could we prepare for something like the reserve, the dollar being replaced? What might be the ramifications? I think that hopefully that speaks to it, so we can move into strategies here. But hopefully that speaks to the point that the dollar's value has been impacted negatively. Like Jay said, inflation is good for a real estate investor, but it's bad for the dollar. It's not a good thing for the dollar. It devalues the dollar. And if the dollar is not universally traded, then it doesn't have as much value in that respect. And you could explain that way better than I could, but hopefully that gives you some sense. But that's why a lot of people talk about putting some money or converting some of their cash to gold or other hard assets, because they just maintain the dollar value of them, if you will, or increase. So that's that. So let's talk about your investment strategies, or what investment strategies you see being beneficial for you, and maybe something that some folks can learn from here. As far as, is it multifamily? You mentioned 150 unit. You're still buying some single family though. Like, what do people need to be mindful of as they say, okay, I get it, Jay, we're heading into a good time for real estate investors, as far as like low interest rates. Borrowing is going to be pretty, not easy, but it's going to be less costly to borrow. Rents are going to go up, so it's a good place to park your money into a building or a property where you're going to get rent. So how do they do that? Do they walk out right now, just buy anything that you see because you're going to get 2.5% interest on some properties, or is there a different way of thinking about it? Anything different than what's been over the last 4, 5, 6 years?
Sure. So let me start with, there are two major types of investing strategies, and people can argue about whether they're really investing or not, and talk and argue about terminology. But essentially, in real estate, we do one of two things. We're either transactional. We buy something and then we sell it for more money, or we buy it with the goal of selling it for more money, or we buy something with the goal of generating income or cash flow from it. And stuff like wholesaling or flipping houses, that's very transactional. The goal there is to buy low and sell high. Anytime you're worried about the economy, anytime the economy, even if it's stable, if there's concern that things could change quickly, transactional investing is a bad strategy. I don't recommend anybody that's not a seasoned investor go out and start flipping houses right now. Can you make money? Yeah, you'll make money until you don't. And people learned this in 2008. I mean, it's easy to make money when the market's going up, but when things can stop quickly. So I'm not a fan of any transactional. Wholesaling is a little bit different. Obviously, if you're not putting your own money at risk, there's a lot less risk. But I wouldn't recommend anybody be flipping houses right now if they don't know how to flip houses and they don't understand the risks. That takes us over to the income producing investments. On the income side, there are a number of investments that still work. What I like to say is the strategies, income producing strategies still work, but you are going to want to modify your tactics and specifically what you're doing. So for example, buying notes. Notes are a great income producing strategy, but not all types of notes work in all types of markets. So should you be buying non-performing notes or performing notes? Should you be repositioning notes, etc.? Same with the rental market. So with rental properties. So buying rental cash flowing properties is good in any market, but sometimes you want to change up your strategies. You don't necessarily let me get more specific now. So if I'm concerned about a market changing, typically what happens is a couple things happen. One, rents start to decrease in the Class A properties faster than in the Class B. In Class B, faster than Class C. We tend to see a higher compression in rents in the higher class properties. So if you're really concerned about the market turning, and right now I am, you should be staying away from Class A properties. Focus on Class B properties, or better yet, focus on Class C properties. Brandon Turner, who's a good friend of mine, realized this a year or two ago, and he's been focusing on mobile home parks. And I think mobile home parks are a fantastic strategy right now because everybody needs a place to live, but they're not necessarily going to live in the most expensive place. So one thing I'm telling people is focus on the B class or the C class properties as opposed to the A class properties. If you're going to buy cash flowing real estate right now, and I like cash flowing real estate right now, be more conservative. So when you go to underwrite the deal, assume that rents are going to drop 10%. They probably won't in all markets. But worst case, again, if you look back at 2008, the worst case rent drop across some big markets was about 10%. So if you're underwriting a deal that you're considering buying right now, assume rents are going to drop 10%. That's pretty much your worst case scenario. Also assume that vacancies are going to increase by 10%. If you're seeing 8%, assume it's going to go to 9 or 10%. Because sometimes we see vacancies rise. So just be a lot more conservative in your underwriting. And if the deal still works, if the numbers still work with lower rent, with 10% lower rent and 10% higher vacancy, go and buy it. Because again, if I buy a $100,000 property today and it's worth $5,000 tomorrow, as long as it's still generating the income I projected, I don't care what the asset value is. I'm going to hold this long enough that the value is going to come back. So whether the $100,000 property is worth $5,000 or $200,000, it doesn't matter to me because I'm not planning to sell it anytime soon. What I care about is that I get stable cash flow from it.
Speak to that on the multifamily side, if you could. Like you're going after this 150 units. So you mentioned, and you're right, if you've got a debt service payment that's manageable through a 10% drop in rent, and I'm experiencing that in a small college town that I have a couple duplexes in. Yep. Rents dropped. It just happened.
Yeah. College towns right now, unfortunately.
Who would have seen it, right?
Yeah, exactly.
What we talked about before. Who would have thunk it? I thought, this is a great cash flowing town, and it still will be. But right now, I'm hacking away, just surviving on those properties. But where was I going with that? Multifamily. So on those properties, for me, the reason I can muscle through is between the two properties, the total debt service is like $1,000 a month. I can pay that with essentially one rent, and I can get through, right? I can get through a 30-year fixed loan, right? In the commercial space, though, I might have a 3 or 5 year term where I have a balloon coming up. Yep. What are you doing in regards to that? Is multifamily just that? Is it the belle of the ball in the commercial space, so you're not worried about it? Because office is, God knows, retail, God knows, but man, commercial multifamily is so special, and lending is so easy right now that you don't care. Or do you have specific things that you're doing to hedge?
So multifamily is, and it's really hard to speak in generalities because there's so many factors that play into it. One, location is super important. So when we talk about multifamily, when we talk about rentals in general, the things that we look for in a location are the three biggies are population growth, employment growth, and wage growth. Mm-hmm. We always talk about those three things. The one thing we don't talk about enough that I think we need to start talking about more is employment diversity. Anytime you're investing in a place that the entire employment base is reliant on one industry or two industries, there's a lot of risk. And so we're starting to see that, like, I'm buying my multifamily in Houston. I am not buying it in the energy corridor of Houston, where about 90% of the population works in the energy field. So I'm focused on a part of Houston where 7% of the population is in the energy field. And there's a whole lot of employment diversity around that area. So that's number one. Focus on employment diversity, focus on population growth. So I don't want to detract from that. Population growth is huge. And what we're seeing is that there are a lot of new and different population trends these days than there were even 6 months ago. 6 months ago, to think that people would be leaving San Francisco and New York and Boston, that was pretty unfathomable. Even if you would have said there was a recession, people leaving these big cities didn't generally happen. But with COVID, kind of changed the equation. And what we're seeing is a lot of people leaving big cities. I read that last month, San Francisco real estate was down 24%.
Wow.
I mean, people, I haven't seen the numbers for New York and other big cities, but I imagine that it's probably softening there as well.
That's '08 level, is it not, for those cities?
Oh yeah, right? It's crazy.
Yeah.
And the big reason is there are a lot of big companies that are now telling their employees, go work from anywhere. You're not coming back, or you're not coming back soon, or we're going to let you work remotely. And a lot of people are moving from a lot of these big cities to places where they would rather live, not living someplace because they have to live there. I would have thought 6 months ago, and again, this is who would have thunk, 6 months ago, I was really concerned about Florida. I live in Florida. Florida is the entire, well, not the entire, but much of the employment base is tourism. Mm-hmm. And so I just assumed that if you looked at 2008 and 2001, Florida got hit really hard during the recession, because during recessions, what do people do? They stop traveling. They stop going to tourist destinations. They stop going to Disney World. They stop going to the beach. And I was really concerned about Florida. Well, COVID's kind of changed the equation. Now that people can work from anywhere, a lot of people can work from anywhere. There are a lot of people who are like, oh, Florida's nice. There's no state income tax. It's on the beach. It's hot, but that's okay. It's still relatively inexpensive. And we have an influx of, I think they're expecting 500,000 people more to come into Florida this year than they were anticipating at the beginning of the year.
That's insane.
Wow. So COVID is definitely changing things. So you have to pay attention to these things. You have to know how population trends. Don't just go look at the 2010 census. Don't go look at 2-year-old data saying this is where the population's moving, because that data may already be outdated. So start thinking about, where do people want to live now that they have more opportunity to move different places. Think about the places that are less conducive to living with COVID, and big cities tend to be a little bit more difficult. And so pay attention to those population trends.
Okay. Somebody asked how David Green is coping with San Francisco. I don't think he's right in San Fran, right? He's outside, isn't he?
He's in Oakland. He's in Oakland.
Which
I think he's doing well. I mean, there's a lot of transaction volume, but prices are softening. Yeah. It's not that people aren't buying; it's that prices are dropping because there's a lot of inventory in the market. Another thing I'll say about multifamily is that there's different types of multifamily investing. There's kind of stabilized investing, where you buy a property that's generating income and you're generating cash flow from it. Then there's the value add, which is you go into a property that's not generating a lot of income, or as much income as it could, and you spend 3 or 5 or 7 years improving management, bringing up rents, doing capital improvements. You get the value up and then you resell it. These days, I would definitely tend to favor multifamily real estate that is cash flowing, that's relatively stabilized, even if it's a value add. We bought a value add, but it will generate a 6 cap this year. That's not enough to get our investors the return that they're ultimately going to want, but it's enough to ensure that even if COVID reemerges really bad in the next few months, and we can't get new tenants in and we can't do any improvements, we're at least still cash flowing.
Yeah.
I wouldn't go out and buy a multifamily right now that's generating negative cash flow, that's costing me money every month, because I don't know. I mean, I'm projecting right now that it's going to be a year before we can really start on capital improvements, because people aren't moving out as much as they were. People don't want contractors in their apartments. So if you're going to be doing multifamily, focus on those things that are generating some cash flow, because it could be a year, 2 years before you can really start implementing some of those, that business plan to improve and reposition.
Makes sense. Now we are at the top of the hour. I think if enough people beg, you might stick with us for a few more minutes. Fair?
Absolutely. Absolutely.
So if you can give Jay a little love, how's it going so far? What are you guys getting out of this? I'd love to hear from you. I mean, this has been chock full. Like, we've barely rested on this broadcast. So let us know how it's going. Huge value add I'm seeing from Napoleon. Love it. Awesome discussion. Really, really good stuff. So we'll keep rolling with this. I have a quick side question. I actually got this question in advance, and you've kind of touched on it, but specifically with cities, you mentioned 25% reduction in price in like a San Francisco or a Boston. Hey, look, I'll admit, one of my goals, I love the city of Boston. My wife and I would love to retire to a penthouse loft in Boston one day. By now, or are cities done?
I don't have a crystal ball. What we learned in 2008, just to be contrarian to everything I just said, what we learned in 2008 is that people tend to have pretty short memories.
Yeah.
So sometimes it seems like there are these obvious consequences of what's going on in the world, and everybody's perception changes and everybody starts acting differently. And then, I mean, it's like we all go on a diet and we eat healthy for a week or 2 or 3. And it's like, oh, our whole world changed. And then a week later, we're back to our old bad habits. So right now, it certainly appears that people are leaving cities in droves, and they're going to places where they'd rather live because they have more freedom and flexibility with their employment. They're moving to less expensive areas. They're moving to areas where they can buy a larger house for the same amount of money, because a lot of people with COVID, we were talking about this before the broadcast, COVID makes it tough to kind of be at home with your family 24/7 in a small house. So I certainly wouldn't want to be in a 600 square foot apartment in New York City with my wife and kid if I had an alternative. So it certainly seems like there is going to be a transition from high density areas to lower density areas, from areas that are more focused on work and employment to areas that are more focused on leisure and cost of living. Whether that is something that will play out long-term, who knows? But it certainly seems to be a short-term trend.
I love what you said about population being one of the core pieces of, where's the population growth? And I don't know, maybe this is me, Jake, correct me if I'm bastardizing your point at all. But I think for a lot of people that may not be in a Florida or a Texas, or say, hey, everyone's investing in Florida and Texas, like, I just don't want to be part of the herd. I get it, but there's so much competition there. The reason why real estate is so dynamic is there's no market, right? There are many, many markets. So if you're in, I'll just use my state that I live in now, for example, there, from Detroit and some of the other cities, there's attrition, but there's movement from, say, a Detroit to where I am, in the county that I am, for instance, right? There's growth there. Yep. So even investing in a market like that, if you're sitting on this call thinking like, oh, Florida, Texas, do I have to go to one of these Sunbelt states or whatever? Maybe, if you want to, but I think there's something to be said for where is population relocating within your market, because that also is an opportunity for buying. Would you agree with that statement?
Absolutely. Yeah. I mean, it's yes, sometimes it's hard to make the decision, I'm going to do what everybody else is doing. We want to be contrarian. We want to say, we want to find our own path, and if everybody's doing it, it's probably not a good thing to be doing. But then you have to question, like, is everybody really doing it? So there's a lot of development in Florida. There are a lot of people investing in Florida. But the opportunity I see in certain parts of Florida, I'm not going to say the whole state, I'm not familiar with the whole state, but the opportunity I see in certain areas, there's opportunity for a whole lot more growth than what we are currently planning for. And so it's easy to say, Florida is being overbuilt and there are too many people investing there. And I said that before I moved here a year ago, but now that I'm here and I realize how much empty land there is, and how,
especially on your side,
especially on my side. Exactly. And again, this isn't necessarily the whole state. I'm on the West Coast of the state. And basically there's a couple big cities, and those big cities are separated by a half-hour drive of just empty land. And so I see a ton of growth and opportunity in those in-between spaces over the next 5 or 10 years. So maybe Florida in general is overbuilt. Maybe there are a whole lot of investors in Florida, but I'm seeing pockets of opportunity. And that's the thing. I think it's easy to be lazy as an investor and just say, everybody's doing that. Everybody's doing this. I should be doing that. I should be doing this. And not really doing a lot of due diligence. And what I tell people is dig in, and it's not fun. It's hard work. But you can probably find opportunities in your area, wherever your area is. If you're willing to drive a half hour, 45 minutes in any direction. Obviously, it doesn't work everywhere. But in most places, if you're willing to drive a half hour or 45 minutes, you're in a whole new market.
Yep.
And there are probably more opportunities than you recognize because you're just looking around and assuming everywhere within a 5-hour drive is the same as 5 miles of you.
Makes sense. Hey, Ben, you should really consider maybe some development on the west coast of Florida.
No. So I was using that. West coast of Florida is a horrible, horrible, horrible place to invest. Please, nobody.
Oh,
Nobody
Ben.
come down there.
Ben's got a problem. No, just kidding. But we'll keep going here. I saw a question about flipping. Jay, are you flipping? So you mentioned before about flipping and transactional work not being the best place right now. Are you still flipping, and how much of a margin would you keep for a market drop? They're asking about DC. I don't know if you know DC at all. I don't know if you've ever invested there, but just generally speaking, any advice if somebody's saying, hey, I hear you, Jay, but I love flipping. It's my thing, and I know my market's going to be strong. Like, what are some tidbits of things that maybe you are doing or that you would do if you were flipping?
Yep. So I tell people that haven't flipped before, you probably shouldn't be flipping. That said, I am still flipping. And actually, I just moved from DC a year ago, so I do know the DC market. I can talk about that a little bit.
True.
But what I say, and again, we talk about in real estate, there are strategies and then there are tactics. And real estate as a strategy, I'm not a huge fan of right now. But if you're going to flip, there are certain tactics that I recommend. So here are the things that I'm doing with the houses that I'm flipping, and here's the tactics I'm using to continue flipping. One, I'm not confident that the market is going to stay strong for the next 3, 6, 12 months. I'm pretty confident that at least where I am, the market's going to stay strong for the next month or two. So I have no problem buying flips that I know that I can turn around in the next month or two, meaning I'm either buying cosmetic flips, or I'm buying stuff that I'm wholesaling, or I'm buying stuff that I'm wholetailing. If I know that I can be in and out of a deal in 6, 8, 10 weeks, I'm going to be a lot more comfortable than if I take on a flip that I know I'm going to be holding for the next 6 months, because I don't know where the economy is going to be in 6 months. Obviously, I don't know where it's going to be in 2 months, but I'm a lot more confident it's still going to be strong in 2 months than in 6 or 8 months. So if you're going to flip, stick with the really quick flips. Stick with the easy flips. Don't do things that are going to take you 8 months just to get permits or inspections. Number two, typically when we see a market downturn, an economic downturn that affects real estate, it affects real estate at the margin. So typically well above the median price point and well below the median price point start to slow down much more quickly than houses at the median price point. So if you're in an area where, let's say, median price point in my area might be $350,000, I'm going to flip houses that I can resell for $350,000, give or take. I'm not going to flip $1 million houses. I'm not going to flip $50,000 houses, because when the market starts to slow, it's going to slow at those margins before it slows at the median. So focus on those areas focus on those houses that are right around the median price point in your market. Number three, school districts. School districts are huge. So if you look at the 2008 data, good school districts saw a much, much, much less reduction in asset value than bad school districts. It's just, I obviously we can all guess why that is. People that are buying houses, people that have the money, that don't necessarily need to get a loan, that have the cash or that can qualify for loans, they tend to be people that prefer to buy in good school districts. They're better qualified, and if you're better qualified, you're going to want to buy in good school districts. So definitely buy in good school districts. And then the last thing I'll say is know your margin. So somebody asked about what margins I'm flipping at. Typically, what I like to do is I like to look at 2008, use that as a barometer of kind of the worst case scenario, and ensure that my margins cover whatever the 2008 drop was. And let me explain what I mean by that. Let's say I'm flipping here. Let's say I'm flipping in Maryland. So I just moved from Maryland, DC area. DC, the parts of Maryland and DC where I was flipping houses, drop in 2008 was relatively modest, 12-13%. DC is a pretty resilient market, just because the government's there and there's a lot of turnover. But 12-13%. I'm comfortable flipping houses in that particular market, assuming that I'm going to project at least 12 or 13% returns. That way, if we see a 2008 type event and the market drops 12 or 13%, my flips are still likely to break even.
Right.
Now, I'm also flipping in Florida. The area where I'm flipping in Florida in 2008, we saw 30% drops in asset values. So I want higher margins here where I'm flipping. Now, again, I'm a little bit more bullish on Florida now than I would have been in 2008. So it's not really 30%, but I'm still going to want higher margins here in Maryland and Georgia. I do some flipping in Georgia, and I want higher margins in Georgia because that saw a big drop in 2008 and the fundamentals of those areas hasn't changed. So if we see a major downturn, those areas are likely to get hit harder than Maryland, DC. So I'm going to look for higher margins there. But typically speaking, I look at what happened in 2008. I say, that's my worst case drop. And I look for margins that will allow me to get a comfortable return or a not so big loss, assuming that worst case scenario happens again. How can you,
I hope people wrote that down, school districts buying short-term flips, median pricing, kind of hitting the median pricing, and your point about 08 and what kind of happened in 08 is kind of your margin that you're looking for, your return that you're looking for. Like you said, generally, when you said 30%, I'm like, I doubt you're targeting 30% on properties in Florida, but maybe you're targeting 15 to 20 as opposed to.
Well, here's the thing: if I know drop 30%, maybe I'm targeting 15%, but I know that my risk is a 15% loss.
That's true.
So am I willing to take that risk? At least I can quantitatively determine what my risk is and decide if I'm willing to accept it or not.
That is an unemotional and perfect way of putting that. I'm so glad you made that point. Thank you for clarifying that, because that is a great way for people to take away, me included, how you sort of quantify the risk, as you said, in any investment that you make. Somebody asked a question, and it works well here. You've talked about population growth. You've talked about what happened in 08 around the housing crisis, these stats, these numbers, these metrics that you're kind of pulling up to figure out what do I, when do I, where do I. Do you have any advice? This is kind of tactical, but any advice or specific sites or places that you go that you find the data to be most reliable in your experience?
So two places I really like. So for single family, for multifamily, there are plenty of great places that sell information and even put out, like Marcus and Millichap is great. They put out a quarterly report that's great. But for single family, which is more my area of expertise, two places I like to go are local realtor associations. So generally in any area, there is a group of people, a group of realtors that kind of call that home. They have an association, they probably have an office, and they keep all the data on that area, historic data and current data. And so if I'm going to a new area, the first place I'm going to go is I'm going to walk into the realtor association and I'm going to say, give me your current data, give me your historic data, give me links that I can go to find data from 2008 or 2010 or 2000, whatever. Love the realtor associations because these are the real estate agents and they have to have the data. And they do have the data. Number two, I love property managers. Property managers tend to have a great set of data because, again, this is their business. If they don't have the data, they're probably not very good property managers. Any property managers that were around in 2008 that are still around today probably have a whole lot of great data, especially for buy and hold investors, on how rents were impacted, on how values were impacted, on how occupancies were impacted. If you want to find things like physical vacancies versus economic vacancies or occupancies, they have all that data because they're managing these units and they have to have that data. So that's where I start. Anytime I go into a new area, find the big property managers, make sure they've been around through at least one recession, and then find the realtor associations.
I love it. That's great advice. Again, for everybody on here, I hope you jotted that down. And I'm looking through some of the questions, a few in here that I think I think we've touched on, to be honest with you, to some extent. But one I do want to touch on before we start to wrap up here, only be out of respect, especially for Natalie. Sounds like her husband's in the military. They're moving to Florida. Any specific markets? You mentioned stay away from the West Coast, which Ben now knows, and we'll make sure he does going forward. Right, Ben? Listen to Jay Scott. He knows all. He said it at the beginning. He's got a crystal ball. This is what I heard. He's got a crystal ball. What he says is always right, and he's never been wrong. I believe those are the three statements that he started his
Exactly.
right. And he's never,
I
but not the West Coast. But where would
and thinks you were telling the truth there?
That's right. Where in Florida would you recommend Natalie and her military family? And thank you, Natalie, to your family for their service. Invest. She said they're moving to maybe Orlando.
Yeah.
Any advice?
So one, thank you for your service or your husband's service. I am a big fan of, again, there are a lot of places you can make money in real estate. So I would start with the question, where do you want to live? If you like Orlando, you want to live in Orlando, then live in Orlando. And I promise you that within 45 minutes of Orlando, there are going to be some great places to buy real estate, to invest. And there actually are. So there's a corridor between Orlando and Tampa that has a couple cute little towns that I really like. Lakeland, Winter Park. And my partner, if he's listening to this, is absolutely going to kill me that I just mentioned those areas. But I know that there are some other investors that if I name them right now, people would have heard of that are looking in that area. So that's one of those, not yet overbuilt, not yet over-farmed, but a lot of people are starting to look there. So yeah, the Orlando area, Tampa area, up and down the West Coast, there's a lot of opportunity in each of the towns. Not much in the center. There isn't much in the center of Florida. Maybe somebody has pockets there that they know of, but I haven't seen much in the center. And Ben can probably talk a lot more about the East Coast of Florida. I'm not familiar with the East Coast.
Yeah, I think John Lim sneezed here. He said Apopka. Is that a town that?
Apaloka.
I don't know. It says Apopka.
Yep. So something else I would suggest. Well, this is a way we have found one of our most promising markets, I think, on the West Coast, is look at data of airport traffic increase. It's like you get some interesting numbers to see, what especially in states like Florida, where a lot of it is based on tourism, like you said. Am I muted?
Yeah, you're good. No.
Yeah,
you're good.
Yeah, there's the more people tend to fly into a specific place, the more opportunities. For me, that's another thing I look at.
It's a good point. RSW. I know what you're talking about right now. RSW. Good job, Ben. So the reason I did this, you just saw I have no sense of direction. He put Apopka is northwest of Orlando. So in my head, I had to go north and west. So that's why, Ben, I apologize. I made you feel like I can't hear you. But look, there was a really great post. Jay, I think you follow this guy. Really, really smart real estate investor. And he put something on recently about the mistake a lot of investors make is they either overcomplicate or undercomplicate investing. Do you know who put that up? Do you know who wrote that?
I think I wrote something a little bit
I think
about
you
that.
did. I think you did. And I think you summed it up really well. Like, people get in their heads of like, what's the right place? What's this? What's that? And this is not, me included, this is not like accusatory in any way of anyone on this call. I'm in the same boat. Like, I'm always wondering, like, I just invested in a syndication in Texas because it seems like I'm supposed to do that, right? Like, that's where it's supposed to go. But the point that you made is, hey, where are you? Like, if you're in Orlando, do that 30, 45 minute circle around it. Maybe this is where you're overcomplicating if you're overthinking this. Look around that area and find a neighborhood, a market, whatever, that meets these fundamentals. You mentioned population growth, job growth, wage growth, something within. And even here in Michigan, which has its ups and downs, its ebbs and flows, there are really great markets here. Places people never heard of on this call. And there are really big markets here that people know of and wouldn't invest in. But you have to find within where you are, and I'm repeating this for myself, really, the markets that make sense for you. And there's opportunity there. Brandon built his career on this in nowhere, Washington, right? Finding a nice little town that he lived in or lived near and invested in a bunch of property with a goal of going to Hawaii, and look where he is. He's literally living his dream. So great example. And I think that's a great way of putting your advice, which I thought was fantastic. I looked at a bunch of your posts, to good use, and overcomplicating or undercomplicating are two things that we all do. So great advice. And I think the way you laid that out really supported that. Cool stuff. So we'll wrap it on that note, but I want to get one more plug in here, guys. This was unbelievable. Watch this again. It'll be on YouTube soon. Go back and watch Jay from last year. He says he's wrong a lot. If you watch him from last year, he's right a lot on what he saw, what happened, everything else, whatever. Buttering up a little bit, I'll admit. But at the same time, you do a great job, and this is why I wanted to have you back. But the book again is?
Recession-Proof Real Estate Investing.
Okay, Recession-Proof Real Estate Investing. Looks like Ben just dropped the link in the chat from Amazon. So please click on that, buy it, support Jay, and get some great information out of that book. I've read a few of Jay's book going back to when he was relatively unknown at Bigger Pockets. I forget the first book. It was very tactical. It was literally like calculating costs on flipping. What was the name of that book?
The book on estimating rehab costs.
Well, how much more simple could you have made it? There was some catchy title to it. I can't remember what it was. But anyway, your stuff is very valuable. All of what you put out is valuable, including and especially what you put out tonight. So I truly appreciate all of what you've done here, all of the information you've given here. Anything else you want to talk about, anywhere people can follow you, find you, or whatever the case may be? Yeah.
So if anybody, I'm not shy of giving out my email address. So if anybody wants to get in touch with me, the letter J at jscott.com. My website's jscott.com or 123flip.com. Anybody that's looking to flip houses, I document in gory detail the first 50 flips I did back in like 2008, 9, and 10 on that website. You can find me on Bigger Pockets, on Instagram, jscott_123flip, and on Facebook, jscottinvestor.
Beautiful. Always adding value. That's a key to the J Scott brand. Benoit, what do you think, buddy?
I think adding value is what we got tonight for sure. It was, just very, very impressive.
We learned about inflation, the reserve currency, and what it means, how to invest in real estate, how to flip houses. I mean, in an hour and 22 minutes, this guy just dumped a ton of knowledge on all of us. So I'll go back and watch. We'll put this out on YouTube. Go to youtube.com/multifamilyandmore. You'll subscribe if you would, please. Make sure you watch this video back and take some snippets, share it with friends, whatever you can do. Great information from Jay. Jay, thank you again. Much appreciated. Hope you have a wonderful evening.
Thanks, guys. I appreciate this.
Absolutely. Great to have you. We'll have you back again, I'm sure, at some point. I'll bug you again in 6-8 months.
I would love that.
I appreciate it. Ben, have a great night, everyone.
Thank you.
Thank you. We'll see you soon.